The first mistake is taking too much money. Yes, this is actually a potential issue. So, in general, when it comes to the investments, a lot of the LPs, limited partners, who are essentially the folks who have the money to go and invest, work with GPs, general partners who represent venture capital companies, private equity companies, to help them distribute their capital. LPs want that capital distributed. Once they allocate it and they said, I want to invest X millions of dollars this year, this is their quote unquote budget. And they want to deploy it because they also plan for a certain rate of return on that money. And so that helps them kind of like budget through the rest of the year, next 5 years, whatever their timeline horizon is for that investment. So they're always rushing to invest. And for the creators, it can be a very exciting opportunity, especially if you're a hot creator or creator in a certain niche that is becoming very popular with the investments. And essentially, folks are knocking on your door saying, hey, take this money. The reason why they would say it is one, could be because you have an amazing idea and something investable, and this is awesome. But two, it can be that they're under the pressure from their LPs to deploy that capital. So don't rush into this entire situation and take way too much money just because it's available. There are situations, and we'll talk about it in a second, when it's applicable, but in general, always plan accordingly. If you have certain idea, for example, you want to open a physical product brand around your niche based on the type of work that you've done as a creator, build the budget. Think about it. Okay, what the timeline looks like. In the first year, I'm launching a single SKU. In the second year, I'm expanding to 2 SKUs. In the third year, maybe I'm opening a pop-up shop in several different places and I start going a little bit of a retail and digital, right? You will have certain plans. And based on that, you can start thinking about the expenses. Start thinking about the warehousing, thinking about the production costs, the support costs, the returns, refunds, all of that. You have to model it all. I know it may sound tough, but in the game where you're potentially going to take on millions of dollars from the market, from the investors, you need to make sure that you have a plan on how to deploy that capital, because you will also need to make sure you'll be able to explain to the general partners how you're actually going to make the return on this. And they're going to challenge you. They're going to investigate the area. They're going to investigate the industry. They're going to help you make sure that you are applying the investments appropriately. And the worst thing you can do at that moment is just over raise the funds. Again, it can be exciting, it can feel great to raise 50 million versus just 10 that you need, but then you're going to be under pressure to deploy that capital as well. You're going to be under the pressure to say, okay, I need to go and hire people, and you might overhire individuals, and all of a sudden now you have people sitting there asking you what they should be doing for their work, and you have no project for them because you're still standing up some basics of your business. You have to make sure you don't get swayed by the idea of high number that you're going to raise, high valuation that you're going to assign to your business. Be reasonable. What is at the pace that you can predict? What is at the pace that you can manage as an individual with the team that you currently have? And how would you increase the velocity of that pace as, say, you add a few partners on the operating side, on the business side, as you expand the brand, as you explore the niche? Because there's so many variables that will happen within the company as you're building it, ignoring even the fact that the macroeconomics can change, the industry can change, there might be some financial crisis, something else. Like, there's so many variables that will happen that no matter how much sometimes you plan, the next 3 years might be a lot different than what you've predicted. So you want to make sure you have multiple different scenarios. What happens in an economic downturn? What happens in an economic upturn? Like, there's a lot of planning. And I know I'm throwing a ton at you right out of the gates at the beginning of this video, but that's the whole point. When in the world where people want you to take their money because they want to invest and they also sometimes just want to deploy the capital, you have to be the judge of what is the right number to raise and how you're going to apply it. If you don't have a good plan, pause, go back to the drawing board, find a couple of people, work with them on your operating plan, work with them on your investment plan. I do this kind of work. You can always reach out and I can for free just kind of give you a quick feedback on your modeling. But essentially, you want to make sure you have a very strict plan that you're going to follow, where you account pretty much for every dollar that you're going to raise from that raise, so that as you get closer to the deployment of the capital, as you actually raise the capital and you start investing in all those projects, nothing is a surprise. You have several different scenarios, one middle scenario, one up scenario in case things are going really well, and one down scenario when things are going to go really bad. And now you're prepared and you start executing. Second biggest mistake that I see: people overestimate the potential gains and the value that they're going to generate with their business venture. AI is a fresh new example today, where you can see how many different startups are valued in tens of billions of dollars and they're barely making any revenue. This is a common mistake. A lot of these startups, when especially they're in the hot industry, they have some interesting technology around them, they're priced as if they already cornered the market. And they're at the very beginning. They're yet to even sometimes sell a couple of customers on their idea, yet the valuation already represents like they're done and dusted, they won the market, and they're, like the Nvidia of the world, and they completely cornered the entire industry. Don't make the same mistake. Don't overestimate the potential for your business. You have to be very reasonable with a TAM calculation, which is total addressable market. Say again, one of my favorite examples can be a cooking industry. Don't assume that all of a sudden every single home chef is going to buy your product, right? It's going to be a very small subset in a very specific niche. Maybe you're making some baking utensils and things that can help folks be better at making lava cakes, whatever they might be. There's a very small contingent of the market who is actually interested in that. And you have to be conservative off of that for two reasons. One, because if you're conservative enough, the valuation of your potential company will be reasonable enough. So you will know that you cannot raise the funds, say, at a $10 billion valuation for the business that maybe has $100 million in it. And then that means that you will also be very conservative when raising the money, and kind of like from the first point, investing just enough to not give away too much of an equity. Because if you overestimate the size and potential of your business, it's going to be stress on you to deliver. If you said that it's going to be a $10 billion business, you better prove in the next 5 years that you can make it a $10 billion business. Otherwise, the investors are going to be on you. The investment company that you're working with will be on you. There'll be a lot of expectations from your employees who probably received certain stock in correspondence to that valuation, right? All of a sudden, there's a lot more pressure on you. And it's okay sometimes to say, hey guys, hold up. We know what the market looks like. We know exactly what kind of revenue maybe we've made from a couple of test purchases. So this is only a $10 million business. And we're going to only raise about $1 million to support it and take it to the next level until we see a proof that it can be a bigger business. It's a great problem to have when you raise just enough capital to make sure you achieve all your goals based on that financial modeling we just discussed, and you're kind of like moving at the right pace, and all of a sudden you start running out of product and people want to buy more and more and more, right? Like at that point, you can do debt facilities, you can raise funds specifically for the inventory, right? So you don't give up the equity, but maybe you give up the percentage of share of the revenue. Just to quickly fund that, there are a lot of financial vehicles for you to tap into so you can continue to grow. Opportunities are there. The worst thing you can do is claim that you're a multi-billion dollar business and then you have to hit that target. And when you don't hit that target, don't forget, a lot of the investors who are especially going to be investing with creators who are unknown to the marketplace, maybe don't have enough of reputation today, your shares will not be the priority shares in a potential distribution if, say, the business doesn't work out and you have to liquidate. Simple example can be, you said it's a $1 billion business, you raised $10 million at the $10 billion valuation, $1 billion valuation, whatever I just said, I already forgot. And then at that point, say things going, okay, and then they crash. And all of a sudden, you only have about $10 million business on your hands. What will happen in that situation is that, say someone came in to buy that business and you liquidate it to just recoup some money, that for $10 million from sale will go back to the investors first before they go back to you. So you might end up spending 2-3 years building a business, but because valuation crashed and you raised at the high valuation too much money, you will not even see a cent from the sale of that business. Sometimes like you see those companies that are like, oh no, unfortunately, like, we tried to build a $1 billion business, but we unfortunately only sold at like $500 million. And people are like, hey, $500 million is a great number. Sure, on paper it's a great number, but the founder might be third, fourth in line, and all the employees might be like sixth, seventh in line when it comes to the distribution of the funds from the sale of that investment. So you might spend, again, years and years building that business without seeing a cent. So because of this, it's so important to make sure your valuation is fair. And again, if you always want to chat, you can reach out. You can also do a bunch of research. There's plenty of good information online about the multiples, how you can assign the value to the business. You can discuss with some of the investors. At first test runs of the investor conversations can be about like, hey, what is the fair valuation here? To find that rate where, okay, the amount of money that you raise is enough to support all the projects that you have in mind, but it's not going to overblow and you're not going to give up too much of your equity, but you're also not going to overestimate the value of your business. If you make that mistake, as I said, there are a lot of downsides to this. It can look cool on paper that, hey, so-and-so creator just, raised X number of millions of dollars and now it's a $1 billion business. Cool. Yes, it's a nice article, but guess what? You're going to have to deliver. And if you're not confident that you can deliver, stay conservative, find your way towards that valuation as your sales grow and as you show that it's an actually sustainable business. Third most frequent mistake that I see is picking the wrong investor. Investor relationship, right, between the founder and the potential investor is like a marriage. Just because they have a ton of money doesn't mean they're good for you. From that perspective, you have to consider what are your primary needs besides just the funds, right? The funds are great, and we already discussed for the first 2 points that you need to have a plan, you have to have some sort of like reasonable valuation. We discussed it. I'm not going to spend more time on this. Now, since you know exactly the amount, you might have a portfolio of potential investors who can come and invest. Some may barely afford, and you might have to have a couple of them to afford the amount of money that you need to raise. Some might have way more, and they'll try to be like, hey, I'm going to throw more millions of dollars at you down the line. Just come work with me, right? Like, we're this amazing and we're this great. You have to decide what else you might need from the investor besides just the money. And the rough buckets can be, you might need industry connections, right? Say, for example, you're really good in the niche, you really understand the niche, you have the viewership and kind of like the folks to distribute the product to, but you're not familiar with what it takes, say, to build a physical product in this space. There might be an investor out there who already invested in these kind of brands, who already have maybe relationships in logistics, relationship in the manufacturing within that space. Again, coming back to like a cooking utensils, maybe they already have a couple of professional businesses that they've invested in that they have the relationship in, they can introduce you to and potentially even get you the better pricing. There can be just someone who has a relationship to get you introduced to certain, like, again, industry veterans. In this case, maybe you're trying to build those baking utensils for a specific type of restaurants, and that individual knows every single restaurant owner that has a star or 2 or 3 stars in the Michelin guide, right? Like, all of a sudden now you have a network that you can be tapped into and you can go and distribute your product to. And there also can be just an advisory. There can be interesting relationship where the investor themselves might not invest as much, but because you have them now on your capital allocation table, they will be there interested in helping you grow. So they might teach you how to run a business. They're great, and they've multi-series entrepreneurs. They've exited a bunch of businesses, so they know how it works. So although they might cut you a smaller check and you might need to have someone else to go and co-invest with them, but that individual's experience will be valuable for you from the perspective of being a mentor. All of a sudden you see that there's like multiple different considerations besides just the amount of money they can raise. Ultimately, especially once you have a good idea, once you did the right planning and you proved it, and you have kind of like, the pool in that niche as a creator to prove that, hey, I have a distribution for these particular viewers, actually finding money will not be your biggest problem. You will be able to find money. There's going to be capital out there, especially in the current environment. Even in the downturn, there are plenty of companies who are sitting on the dry powder, meaning they're just like sitting on the capital without deploying it. So there will be companies out there ready to deploy. It's more about, are they the right fit? Are they the kind of individual who you're going to be able to work with for the next 2-3 years? Because some of the investors can also be very hands-on, and they might be like ringing you up anytime the sales are not showing up well. After every board of directors meeting, oh, wait a second, the sales are not moving fast enough. What's happening? And they might be applying a lot more stress on you than you need. There might be investors too checked out. You might be like, hey, this is cool. I got like, I don't know, Mark Cuban on my investor docket, and he invested like in a few $100,000. Great, but then Mark Cuban also invested in like 1,000 other companies, so he never picks up the phone and he never talks to you about this, right? So it could be good for your marketing, and it could be good for you to use again his name without investors and say, hey, Mark Cuban invested in my business, go invest as well, because my business is that hot because Mark Cuban is with me. But that might be the value, but will not be the value of actually getting the advice, right? So there's so many different interesting criteria that you have to go through kind of like as you're picking the investors. That's why I genuinely believe that the business partnerships and the marriages are very similar, right? In the sense that who you pick as a partner will not just matter in the short term. It's always about that long-term play. Is that someone you can clearly communicate with? Is it someone who you align with on the goals, and they're patient enough and they're understanding enough to kind of like stick with you as you grow your business, as you grow in a certain direction? Will they be there for you in case things don't work out? Will they be patient enough and help you and kind of like pick you up, introduce you to the right people? Or will they be just like nagging you and further pushing you down and essentially distracting you from the actual problem solving of the business? Can you just communicate with them, right? Like, again, is it easy enough to just pick up the phone and call them? Or again, you have to like, call their assistant and be in line for like 3 months before you can speak to them. All of these criteria matter. Money matters as well, but ultimately you have to be very thoughtful and don't just jump on the first opportunity of like, hey, maybe you've got like tens and tens of no's, and then finally someone said yes, but they're not that perfect of an investor. It's okay to pass on them and say, hey, although I appreciate your interest, I appreciate the fact that you want to invest with me, I don't think we're a good match because you've invested always into like, I don't know, septic manufacturing companies, and all of a sudden we're here in cooking. I don't think you'll be able to help me in the moment, but I'm happy maybe to take your investment down the line when I have a couple of investors who will help me build the business so it's a successful venture, right? Like, it's a very open conversation. People sometimes forget, especially entrepreneurs and startup founders, in my experience, who I work with, about it's two-way street. It's not only about like, oh my God, the investor, the VC came down from the, from the graces of God and gave you the check, and all of a sudden, like they're the divine entity and you have to abide to everything that they say. They're just an individual who joins the organization, and where maybe other individuals join because of their product expertise, their expertise in running a business, their expertise in helping, understand the specific niche. Their expertise is they have money. There's nothing bad about it. They know how to invest. They're professionals when it comes to this, but they also need to provide that value beyond just cutting a check. To sum it all up, don't rush to raise a bunch of money at too high of a valuation, or just take on an investor who you're not even sure will be the great fit for you organization wise, or someone who'll be a partner in this venture. And be very thoughtful. You've spent probably by now decade plus of building your creator brand. You've spent all this time building the relationships, building your reputation, the industry. There's no reason to throw it all out just in a hurry. Take your time, find the right people, find the right amount of money, find the right business idea and the application to those funds before you're ready to pull the trigger. And as always, as I mentioned before, if you're ever in doubt, reach out to me. I've worked with startup founders and private equity and VC companies for like 15 plus years. And I work in the startups building businesses, and I work on the other side in evaluating the businesses, doing the due diligence, and working with the founders to help them ensure that they're building a sustainable business. And this is my passion for the creator economy. I just see the creators are pretty much identical to like startup founders I worked with like 15 years ago. So the type of advice and type of things that you guys will need are very identical to the other, you know, business entrepreneurs from back in the day as I started my career. But now I have a few more, years of experience and some scar tissue to use to share your different things that went well and how things can go wrong when it comes to raising the funds and allocating those investments. So I hope it was useful. Hit me up if you're curious to chat more about this. Otherwise, I'll see you next Saturday. Peace.